Hello and welcome to CMC Markets on Tuesday the 18th of September, and a look at some of the key events of the last 7 days. And I suppose I better start with wiping that egg off my face that I was talking about last week, because what did the Fed go and do? They eased monetary policy. And not only did they ease, they basically undertook to do unlimited, or open-ended, I should say, bond buying to the tune of about $40 billion a month, until such times as the unemployment rate starts to come down. So potentially that could actually go into 2015. The effect on equity markets was pretty immediate. We saw a pop higher in the Dow Jones, the S&P, the DAX and the FTSE 100. But of particular interest was, even though the S&P and the Dow made their highest level since 2007, the reaction of the FTSE 100 was very muted in comparison. I'm going to have a quick look at a chart. It's very significant that we didn't break above that 59.30 area, which is highlighted by a trend line that I've drawn from the 2011 highs. And I think if we're going to see a push higher in the FTSE 100, then I really think we need to break above that particular channel, or not channel, but top of the triangle line. On the downside, we've also got support coming in around about the 200-day moving average. But I suspect that this particular QE rush could well be short-lived if we don't start to see a significant impact on growth, on earnings, on economic data and unemployment. And we've seen the reasons as to why the Fed felt compelled to ease this week, when the Empire Manufacturing for September actually came in at minus 10.4. much lower than expected. They were expecting a reading of about minus 2. So that was a bit of a concern. Weekly jobless this week is expected to remain in the 370. It did go higher to 382 last week, but I think that's probably temporary effects as a result of Hurricane Isaac. And the Philly Fed, I think, is the key piece of data that we're expected out later this week. And again, they're expecting a negative reading on that we're expecting a slight improvement from the August figures of minus 7.1 to minus 3.3. But given the fact that the Empire Manufacturing was so bad, it wouldn't really be unexpected to see Philly Fed actually come in a lot lower than the minus 3.3 reading that we're expecting to see later this week. So that's pretty much it with respect to the US markets. Obviously we've had a sort of filter through effect on European markets as well, and UK markets, and I'm going to come on to them in a moment. Okay, so we've talked about the Fed easing just a minute ago. Now I'm going to cover some of the key events in Europe. If you want to know a little bit more detail, there is a separate video that I'm going to be talking about in more detail with respect to Europe. But the key events this week are essentially driving risk appetite. It's a Spanish bond auction that we've got on Thursday. We've also got PMIs, services and manufacturing PMIs from the Eurozone, Germany and France, and they are expected to show a little bit of an improvement from the August figures, but only a very minor improvement. The key concerns in Europe remain the lack of growth and rising unemployment. Spain tensions still on the radar, worries about whether Mr. Rajoy will ask for a bailout now that yields are a little bit lower. Banking union disagreements as well, and obviously concern about whether or not Greece will be able to get agreement on its budget cuts in time for its Troika review, or the contents of its Troika review are basically published in the middle of October. So these are some of the key events in Europe. As I said, if you want more detail on them, then look at the separate video on that. And now I'll move on to the UK markets. It's also a key week in the UK. We've got a host of economic data out this week. Started with the inflation numbers this morning. They slipped back on an annualised basis from 2.6 to 2.5%, even though they did jump slightly by 0.5% in August, due to essentially higher oil prices, which are starting to feed through. Now, there is a concern amongst some economists that inflation will remain sticky, and I think if Brent prices continue to remain high, then that could well filter through going forward. We've also got energy price rises coming on stream for gas and electricity over the next couple of months, so they could probably underpin prices as well, as long as elevated soft commodity prices. On Wednesday we've got the Bank of England minutes, and hopefully we'll get some idea of whether or not the funding for lending scheme is starting to have a trickle-down effect into the UK economy. On Thursday we have UK retail sales for August, and I think we'll get some idea of whether the Olympics has given the retail sector a bit of a boost or whether it's actually held consumer spending back because consumers have decided to stay at home and watch the Olympics on the TV instead of going out shopping. And then on Friday we finish off with UK public finances, and they were very disappointing in August. They normally post a surplus. They didn't. They actually posted a slight deficit, and that means that the Chancellor is probably going to miss his budget targets for 2012, 2013, and that's going to increase the pressure on him to maybe relax them slightly. The IMF have already stated that it probably wouldn't be the end of the world if he did, but that really does invite the debate as to whether or not he's going to start rowing back on some of the deficit reduction targets. Anyway, so keep an eye on those key items on the economic calendar. If you're in any doubt as to the timing of them, you can find them on our economic calendar on our platform. In the meantime, once again, thanks very much for listening. This is Michael Hewson talking to you from CMC Markets.